All right. CPI is the only thing on the agenda. Everything else is going to fall away after that. From the estimates that I've been seeing, we're looking at anything from a 6.5 to a 6.6. And if you look at the projections for that, maybe they'll have my projections that I've been finding in this link here. Basically, if we come in at 6.7 and above, or if we come in higher than 6.6, the market's likely to head to the downside. If we come in below 6.4, the market's likely to go hard to the upside. And if we stay within the mean or the median estimate of 6.5 to 6.6, then we're looking at some violence and some whippiness and some chop, but nothing that really sticks. The December estimate, if you remember, the market went down in December. That is because we came in at over 7%. So you can see some of the estimates here from Wells Fargo, JP Morgan, BlackRock. So this is going to be the key to everything else at this point, right? We're either going to come in hot or not. Now, we're not talking about something that's going to set the stage for the whole quarter. We're talking about something that's going to set the stage into February for the FOMC announcement. And that will be more of a focus on, are they going to do a 25 basis point or a 50 basis point? But they're going to hike either way, right? There's still no pause. There's no pivot. There's no expectation of any kind of dovish bias or implications or point of view or tone. They're not going to talking about having a discussion about pivoting, right? We're nowhere near any of that. So take this CPI move today with a little bit of a grain of salt that it doesn't have to stick. And when we get to the charts, you're going to see a little bit of what I mean by that. We do have Fed speakers today too. And we have additional auctions today, which is why I continue to stress, watch the clock. It's one of the best indicators you have, and it's free, and it's not new to you. It's a really powerful tool, but it seems too simple for traders, and they ignore that powerful thing. Watch the clock. It was hard to find any other news this morning, anything outside of the CPI. But one thing we can take away from that is that there was nothing overly drastic happening around the world last night. All right, yesterday we had the 10-year. Today we have the 30-year. These are important ones, right? Just like yesterday was an important one. So 30-year bonds, 1 o'clock. If we can get past 1 o'clock and still have a stable market, then a 0 day in the afternoon, you should be free and clear at that point. Just keep your eye on any Fed speakers, right? But economic-wise, that Treasury statement shouldn't have too much impact. And you can always check that if you go over to FX Street. They have like an impact gauge to kind of give you a feel for what it historically has done. All of those from Thinkorswim comes from this company, EconoDay. So, you know, if you wanted to, you could also do it that way. They generally have a discussion on how much it impacts the market, why investors care. That's usually a good link to click right there, the why it cares, if you're trying to learn more about, you know, economic reports. All right, as we would anticipate, the cumulative volume is a little light this morning, and that makes perfect sense. So we can just go ahead and turn this thing off. We don't need it today. We have a very muted range. The IB is very narrow. IB is the initial balance. Think of it as an open range, but you don't get to set the time. So between 6 and 7 o'clock, that is the IB. And the IB, or the initial balance, kind of sets the tone and gives us a perspective on how much work was done in the overnight hours. Did those firms get all of their work done or not? Now, again, this makes perfect sense that we're not moving around much because everybody's waiting on the CPI. I posted some numbers on how far the market moved intraday after the CPI report last year, right? And we've seen numbers like 5% in a single day. In the NASDAQ, 7% in a single day. So last year on CPI day, we saw some significant movement. I've got a list on these. Minus 1.8 in February, minus 2.9 in June, plus 2.3, 2.1 in August, September 4.3, 2.6 in October, and 5.5 in November. So when I say a day like this can really move the markets, we ain't kidding. Right? So with that in mind, the ADR levels for today are not going to be enough, right? Our typical 21-day ADR is showing a 1.93%, and we have a market maker move of 1.6%. That's not enough. We need to measure out at least a 3% move and a 4% move. Now, one thing that I want to stress on a day like this, it has been hyped up now for the last 3 weeks. Oh, it's going to be big. Ooh, it's going to be big. Can't tell you how many times I've heard, ooh, it's going to be big. And then it was nothing. Why is it nothing? Because both sides were long and short. There's, you know, 1,000 traders out there all trying to short this thing, and another 1,000 all trying to go long. And they end up just piling into the middle of it. So it doesn't owe us a big move. Today, we could whip around nice and violent and come right back into the range that we had yesterday. It does not owe us a move that sticks. So just kind of keep that in mind. It's not a binary event of up and down. We could just hold the range after the violence, right? Because we could reset, close the gap. So from the close last night, let's start with a 3% move. That gets us to the COG line at 41.11. I love it how everything always lines up nice and neat. All right, so there's our 3% move. A 3% move to the downside gets us below the weekly pivot point and lines us up at 38.72. Right now we have a missed daily pivot as well. We have not tagged that daily pivot. All right, so I kind of cleaned things up a little bit. That's our EM range today, our measured move from 41.11 down to 38.72. For the upside move, it's not enough to give us that higher high pivot, right? We've got to get over this. Even if we didn't use that wick and we just focused on this, we would still just be lined up with it. We'd need to get above 41.12 and a little bit extra, right? That way we could set that higher high. For the downside, it wouldn't get us below for a new low. We need that 3,800, right? So today by itself, just with that 3% move, does not solve this range that we've been in. I'm really getting tired of this range too. I'm ready to do it. Let's do the thing. I don't even care which way it goes. Just go, right? So more than just today, what's the follow through? I mentioned it at the start this morning. We can kind of look back at August. We had that good CPI report. I mean, not good. Bad is good and good is bad right now. We had a CPI report that gave us just a few more days of upside. And then we tagged that 200 period daily moving average. And that was kind of a wrap. And then, of course, Jackson Hole with the mic drop moment when Powell said, screw you, you're going to suck it for longer. And the market really dumped. So it kind of killed the whole CPI vibe. But if you look back at July, CPI off that low, and we had the start of the rally from the July lows up into that August 200 period moving average. Had the CPI report in September, and that was a nonstop drop to the downside after that for the rest of the month. The CPI in October, 2-week movement to the upside. In November, even though it was a really big CPI report, once we moved, we really didn't get a whole lot more out of it, right? We pretty much held the range and had one little hurrah blow off top before we rolled over. And then the December, where we popped up high, didn't keep it, gave it all back within a week, and we've been stuck ever since. So a little bit of expectations, right? This isn't going to carry us through the quarter. It's only going to carry us closer to the FOMC announcement. And then that data is going to become the thing. And right now, it's not even about how big they're going to hike. It's more about what's their final target. And they don't know yet, right? They want to be slightly restrictive, whatever that means. And since they don't know what neutral is, how do they know when they're slightly restrictive? Well, they have to see the data. All right, so now that we've set some expectations on the follow through here, everything's going to get whacked or everything's going to explode, whichever direction the market takes, right? And that's going to last for a few days. We're going to be looking for it to set the tone. All of the micro, small, and mid cap names that started to really bottom or start heading south in 2021, bottomed through 2022, they're starting to do good now. So if you're looking for longs and you're not much of an options trader, that's a good place to focus. Get away from the, the big headline names, the sexy, glamorous, mega cap names. Get away from those. That's a bubble that still hasn't popped yet. And focus on names that have already bottomed, based, and start heading back in the other direction. Index wise, you could use something like the Russell for that, right? Because the Russell is small cap names. Thinkorswim already has that list made for you. So you can just go in and it's alphabetized, go to the public list and go to the Russell. There's your micro cap, mid cap, right? So that'd be a good place to start. Of course, with those smaller names, they're very likely not going to be really great option names. You might find a little, a diamond in the rough. Continue to focus on the theme, the distinction between growth and value, defense and offensive areas. Of course, look at their fundamentals, see who's running things. I don't know enough about those small companies. I could tell you that. Since as an options trader, I focus more on names that have good options. I'm not expecting anything out of this watch list this morning since everything is on hold, but it doesn't take, but a second to come in and look anyways. KWeb is down 1.8. That's our perspective of, China names, internet names in China. Not much of a surprise that it's down a little bit. Gold is up. Bitcoin is really up. And natural gas, nearly 4% this morning. And airlines. Now, we've talked about airlines over and over and over again, that as a bottoming play, these things continued to look really good. Just, from the idea that, well, they got beat down and they're at the lows, they're cheap, maybe I should get them. And I've continued to stress that that's a bad idea if you're looking for a long-term investment. Notoriously, Airlines just suck at managing money. And it seems to be one crisis after the next with these guys. For trading, however, which is completely different than investing, these things have been lit up. These and casino names. They're up again this morning. At some point, we're going to be looking for these to, land us into some resistance and get a reasonably decent pullback. Bitcoin is still working on 50% of that candle. So a nice rejection off that 11.25. If we can get above and close above that on the week, then we could go ahead and focusing on 12, maybe even getting back up into $13 on this. This is that Bitcoin ETF, BITO. If you look at the options, they're not bad, right? But this is a really cheap stock or a cheap product. And if you look at the options on some of these, the spread is pretty horrible. Here on the call side, it's not too bad, but the put side, that spread is just trash. So, pick and choose wisely. If you're looking for some options in here, be very selective on what you're picking and avoid this trash right out here, right? This is all bag holders, trash, junk. Overall, I'm still bearish Bitcoin, but nothing goes down without getting some kind of pop to the upside eventually. UNG's kind of sitting in the middle of nowhere. We've had a nice breakdown. And if we were looking at this from IBD's perspective of a double bottom, then we kind of need a little bit more, right? The way IBD talks about double bottoms is that you want that overshoot. That way you trap everybody, and then you get that spike to the upside. And of course, all of those trapped traders that are short have to buy to cover. They add to the buying, and then you get that explosive move back up. That's not the only double bottom out there, which is why I specify IBD's logic of a double bottom. Just because we've went through it a little bit doesn't quite necessarily count. When it comes to trend lines and support and resistance, angled trend lines tend to fare better than straight trend line. So the fact that we came down and, punched right through this, it makes sense because it's just a line snapped on the end of a wick, right? Need a little more structure there. So we're going to be looking for Natcast to kind of stabilize around the $11. If we close below that on the week, then we're going to go ahead and focus on getting all the way back down here to 8.15. All the easy money, and I hate to use that phrase, but all the easy money's been made in this. There's not much left in the short. You got to be kind of thinking about, where's this going to stabilize? When are we going to build that base and start turning around and heading back in the other direction? It very likely is going to take weeks of building a base and some false starts and trying to get started again on that rounding over. Yeah, the airlines always follow the banks, which everything follows the banks, right? Because the banks kick off earnings. The banks start this Friday. And I don't know, everybody's got an opinion, right? Opinions are free. They're everywhere. With the banks, we've seen a lot of job cuts. We've seen cuts to their bonuses. Some institutions did really, really good. Usually the ones that I've been seeing report-wise that have been doing good on the financial and the banks are the ones that make most of their money on the spread. But a couple of trading firms had some, really solid calls last year. Some of the smaller funds, there was an article on Bloomberg. I'll try to find it and post it for you guys later today that talked about the smaller funds really got ate up last year, and that the mega monster firms like Sequoia and Susquehanna, they did really good last year. So we'll see how it starts to play out in earnings, but they're going to set the tone. And if they were doing so good, why are they cutting bonuses and cutting staff and restructuring? We'll see. So because earnings is right around the corner, hand-picking some stock names for a good trade leading up into FOMC and onto the other side of FOMC, I'm not super excited about the concept, right? I don't want to trade into an earnings event in swing trades, which generally means we're left with ETFs, ETNs, and indexes to trade. And that's fine, right? We could trade precious metals, commodities, bonds, and then the sectors themselves. So there's still plenty to trade. And for short duration stuff, we can still trade all the names that we normally would trade, right? Your Apples and Teslas and whatever. But trying to get a good 6-week to 2-month trade on when we're just kicking off earnings season and all those names need to report, I'm not overly excited about the concept. Caterpillar did get that breakout. There was some, talk that it wasn't going to make it. This was going to be like this really solid rejection, and it didn't reject, at least not yet. It's still holding the line. So a weekly close above this breakout, there is a new long. I know it's hard to chew on trying to go long in something that already has made such a gigantic move, but strength begets strength. Corey Rosenblum wrote a book. I mean, he's wrote a couple books, but he wrote a book that really talked about this logic. How we instinctively try to be contrarians and look at something like this and say, oh, well, it's gone really far, let's short that sucker. But, more often than not, things that are strong and that are doing really well just attracts more buyers, and it continues to stay strong and do really well until something else changes fundamentally. They screw up earnings, their product fails, they get some kind of negative news somewhere that is just going to continue to do good. So, I wouldn't discount Caterpillar right off the gate just because it's made such a big move already. It made it through a real serious structural level. And if it can hold above and close above that level this week, that's a new trigger right there for a long play. McDonald's is another one worth keeping your eye on. It's got to resolve that 270 level. And of course, we're not sitting at the absolute highs, but we're in the upper quadrant of this chart. It continues to try to maintain this great move from October. If you think about the S&P, the NASDAQ, we all, rounded over in October. And we talk about a rising tide lifts all boats. So this went up along with everything else. But while the S&P and the NASDAQ and the Dow are all falling off of those highs, this is not. Still sticking in that upper quadrant. And then Merrick. Now, Merrick took a pretty solid rejection, but it kind of got a little ahead of itself, right? It leaned out a little too far in front of those skis. So it needs to hold 108, keep that stability on the week. And then Travelers set a new 52-week high. But, you know, when we're looking for follow through, we had that big expansion bar on a lot of names. And now we're inside that expansion bar. On the week, holding above 50% of that expansion bar is kind of key if you're looking for like a shorter term trade. Otherwise, we're just focused on where that pivot was from last year and seeing it hold above that level. Now, like I said, I don't tend to trade everything out there. I'm really particular about the options. It's got to have, you know, quote, good options. Just the fact that it has weeklies is a start. If it doesn't have weeklies, I'm very likely not going to trade it at all. Even if it has weeklies, you still got to look at the spread. If you make a habit of trading bad option names all the time, then you're just going to struggle with it. Doing it once in a while, yeah, you know, that's not so bad. So if you deviate from the norm, at least have a damn good reason to do it. Got a little bit of a wedge going on, but this is a weekly chart, right? It's going to take it some time to resolve itself. Continue to focus on basic introductory technical analysis concepts. Higher highs, higher lows, lower highs, lower lows. As simple as it sounds, it works. There's a reason it works. If you notice, I don't have any indicators on the chart. It's not necessarily that I don't use them. It's just they are measuring tools, right? Very much like a tape measure. When you're working on something, you don't have the tape measure out the entire time. You only get the tape measure out when you've got something to measure, and you put it away again. So if you wanted to look for those, maybe a couple of moving averages for pairs, right? So you can run surge, trend, momentum, a MACD to gauge the strength of the move, the inertia. So what we're going to be looking for as we come out of today's data is for the NASDAQ over the next few weeks to resolve back to that 12,000 if it's positive, or to set new lows on the chart, breaking through last year's low, that 1040 area. Not in a day, right? We're talking about over the next 2 weeks. Same thing, coming out of this scoop pattern, getting above 4,100, or retesting that 36. And it would start with first just getting below that 38, heavily defended at 38. Now we've seen 39 defended this week. But it's going to be 38 once we get below 39. And if we get below 38, then it'll be 37. That's how it goes, right? No, I think we're going to leave it at that. All right, there's no reason to run through the volume profile. There's no reason to go through the list of names. Everything right now is all set and focused on CPI. We've got PPI coming up in a week. If you want a little bit of a heads up on what that could be and how you can do that heads up, first you need to get a consensus estimate, right? So you don't need a paid subscription to do this kind of stuff. You go to a place like Market Watch and it'll have the median forecast or the mean estimate, depending on where you're at, right? So we scroll down and we look at CPI 6.5 is what everybody expects today. And what they did is they just asked a bunch of people, what do you think is going to be? Right? I know how silly that sounds, but that's what they did. So then they look at what it was last report, 7.1, and everybody's expecting it to be around 6.5. Well, that's what this place says everybody's expecting. If you go to Finance Juice, it also has a forecast. You go to CPI, 6.5. Okay, so now that's two places that say 6.5. Thinkorswim gets its data from a place called Econoday. When you're looking at the Thinkorswim economic calendar, it reaches out and gets its data from Econoday. Why that thing is not, that's not what I want. Normally it works really good. I very rarely ever get an error on this website. Either way, that is where you can get your estimate. So when you're on the calendar, this here, and you pause and look at this, all of this comes from that Econoday website. But if you look up here, it has your previous up there too. So there's your 7.1. Econoday is expecting 6.6, not 6.5, right? So you're going to find most of the things are consensus. The consensus is going to line up. So then when the report comes out this morning, if it's not 6.5 or 6.6, game on, right? If they're offsides and they're wrong a lot, which, you know, they're not wrong very often. And when they are wrong, it's usually not by very much. But every once in a while, they get it, oh, damn wrong. that's when you see the market really make some moves. So CPI, we're done, right? I mean, it's coming in here hot in like 20 minutes. But you got PPI right around the block. If you're looking to do this for yourself, that's how you would do it. You would first go out and ask the question, when is PPI? Great, you get that date. Then you start checking a couple of economic calendars. What was the forecast? What is the forecast? What was last month's? What was the average? Then you start marking them out on the chart. Maybe that takes a little bit longer work, right? You get a chart like that where you've got those dates. Get a little more detailed. You can put in what the date and the outcome was. So like for December when it was 7.1 and it says 7.1 on it. This can kind of get you into the habit of, one, not forgetting that there's an economic event on the horizon, because you can put those lines into the future, just like I have PPI already marked out. We're not there yet. But then you can also start to get more familiar with the outcome. What happened when it reported last time or the time before that? It's not perfect. It's not going to give you a crystal ball to let you see the future, but you'll be a much more informed trader, right? And a lot of times that's the line in the sand between us and everybody else, is an uninformed trader who will say, gosh, why did the market move so big this morning? Anybody know what's going on? Absolutely oblivious to the idea that CPI was today, and loaded the boat with a bunch of junk in their portfolio yesterday because they didn't even understand that today was CPI day. Call those forced errors. Get those out of the way, right? Try to avoid that kind of stuff as much as possible. If you have questions on that stuff, just hit me up. And, these morning briefings, yeah, they're a little bit of a leg up, get you prepared for the day, but they're also designed to help you get to the point where you can do your own morning routine without, needing to tune into mine. And so if we're working on something or talk about something you don't understand, follow it up with questions later. I'm not hard to find. Still front running that CPI this morning, getting a little bit more expansion in the S&P and the NASDAQ. All right, we're looking at the dollar here. There's been some talk that the run in the dollar is done. I don't know if I would be that dismissive, but if you were to consider, Fibonacci structure and how far a pullback should go, this thing pulled back way too far. So the uptrend is dead. Now, just because the uptrend is dead doesn't mean that it can't start a new uptrend. But we would say that it can't resume the uptrend that it was in, because the uptrend that it was in is gone. So this needs to stabilize, base, kind of hold back in that 2019 level. Prove that it's gonna, and then start to come out of it on the other side. I really feel if we get back below this high back here, if we get back below that, say 102 and lower, then the dollar is going to have a hard time coming back up out of that zone again. And the market's going to see that as bullish, right? The more weakness we get here, the more the market's going to see this as bullish. One more thing before we go, something to wrap up with. On the options. So last CPI, we didn't get the options volatility crush that we would expect, because it was right in front of FOMC. If you guys remember, in December, CPI was right in front of FOMC and we didn't get that vol crush. We're very likely going to get the vol crush today. So first, just be ready for the idea that volatility is going to come out of these options a lot. Even if we go down, it's going to pull volatility out of this market, because an unknown will now be known, right? So that's part of it. But when it comes to options volatility, transactions is what precipitates this volatility in here. So when you're looking at the options chain and you see, elevated volatility higher than the volatility on the side, the average vol, it's because of transactions. So if you get a lot of people trading in one spot, it will increase the volatility in that one spot. So watch the volatility today. If you're trading 0-day, do it in a spread. If you want to trade a naked option, like just buy a call or buy a put, don't buy 0-day, right? Buy something else. 1 day out, 2 days, 5 days. I was in a long option yesterday. I bought an option in the SPX, which its rate of change is crazy violent. And yet that option was slow moving. It felt like it was in slow motion. I held on to that SPX option for over an hour and a half because it was just barely moving. And it was in this grind here, right? When we finally started to come out of it all. So just by backing away a little bit, I removed myself from that real violent gamma in the front end of an option expiration, right? Don't buy 0 days. If you're going to use a 0-day, sell to open, buy to close. If you're going to buy an option today, a single option, step out a little bit on the curve to try to mitigate some of this volatility crush that we're going to see. Ten minutes before the report. This is the December 12, December 13. So it's either CPI or PPI. We had a really big move. And although it does not look like a gap, it creates a liquidity vacuum. It created a gap. And the market spent the rest of the day unwinding that gap. So just kind of keep in mind, it does a little bit. I don't know if I would really say it that way, but IV is calculated with supply and demand in the formula, right? So in the options chain, the IV that you see in there, it uses transactions, volume. Volume is not the right word though, right? It's actually what's that indicator? That cumulative delta volume. You know how that looks at the difference between the bid and the ask, or the ask and above the ask, that kind of volume? Because volume is worthless, right? Volume is just volume. It just shows transaction. We want to know who initiated the volume. Was it done on the ask, above the ask, at the bid, below the bid? That shows aggression. And then how much? So when I talk about an option being attacked, when we're playing like UOA trades, when one strike comes out in a UOA alert, like a golden sweep or something like that, that one strike starts to get attacked. The more they hit it at the ask, above the ask, the more volatility that strike gets. And you'll see that thing balloon in value. That's where the UOA traders really make their money. Not because they bought a call and got the direction right, but that they bought the call that everybody else was buying, and that call strike got attacked. And it swelled up really fast due to that IV change. And the IV changed because everybody was attacking that one strike. Which is why when we talk volatility, we always have to say what volatility, because chart volatility, well, that's closing candle to closing candle. Average volatility within the options chain, well, that's all the out of the money options on the call and the put side. IV per strike, where does that IV come from? From the transactions within that particular strike. So today, we're very likely going to see this kind of a move. And I'm not saying it's going to go up. I'm saying it's very likely going to make this kind of a move. But don't automatically assume, ooh, it went up and then we're going to just trade to the upside all day. Nah. Or, oh, it went down. Now we're going to go short for the rest of the day. Be careful with that logic. We could, but in September, November, and December, all of these were unwound. So we had the big move and then it unwound it the rest of the day. Everybody, be careful, be safe. I'll see you all tomorrow.